It begins with a technological shockwave. Reports emerge that China has achieved a breakthrough in advanced technology, surpassing the United States in key sectors including artificial intelligence, semiconductors, telecommunications, renewable energy, and aerospace. The announcement spreads rapidly, capturing the attention of global markets, policymakers, and corporations. Analysts scramble to understand the magnitude of this development, realizing that U.S. technological supremacy is no longer guaranteed. The first economic reaction is immediate and severe. Wall Street reacts with anxiety as investors anticipate shifts in global competitiveness, corporate profitability, and innovation leadership. Technology-heavy indices such as the Nasdaq and S&P 500 experience sharp declines as stock valuations are reassessed. Companies dependent on U.S. technological leadership face sudden uncertainty regarding revenue growth, market share, and strategic positioning. Corporate operations are disrupted. Companies that previously led in semiconductor production, AI research, and cloud computing face heightened competition from Chinese firms. Product development cycles must accelerate, research investment increases, and operational strategies are recalibrated. Firms dependent on exports or intellectual property feel immediate pressure as market access and technology licensing come under threat. The technology sector experiences profound challenges. Semiconductor firms encounter intense competitive pressure from Chinese manufacturers producing superior chips at lower costs. Cloud computing, artificial intelligence, and advanced manufacturing technologies face disruption as Chinese competitors deliver solutions faster, cheaper, and more efficiently. US-based technology companies struggle to maintain domestic and international market dominance. Stock markets respond violently. Investors anticipate slower growth for US tech companies, leading to massive sell-offs in technology and innovation-driven sectors. Institutional and retail investors alike rotate assets into safe haven investments, including gold, treasury bonds, and low-risk consumer staples. Market volatility spikes, reflecting uncertainty about the U.S.'s ability to retain technological and economic leadership. Research and development pipelines are disrupted. U.S. companies double down on innovation, increasing investment in labs, human capital, and infrastructure. However, competition from China accelerates technology adoption and reduces the U.S.'s time advantage. Intellectual property theft, espionage concerns, and global licensing disputes further complicate R&D strategies, creating additional costs and operational challenges. The semiconductor and hardware manufacturing sectors face existential pressure. Chinese firms producing next-generation processors, memory devices, and electronic components at scale threaten U.S. dominance in critical supply chains. American firms must compete on cost, efficiency, and innovation simultaneously, often straining budgets and reducing profit margins. Supply chain recalibration becomes urgent, as reliance on Chinese components increases risk while domestic alternatives remain costly. Global trade patterns adjust quickly. Countries and multinational corporations shift supply chain priorities toward China's technologically superior offerings. Export-dependent U.S. firms lose market share, while Chinese firms expand influence in emerging markets. Trade deficits and competitive imbalances widen, placing additional stress on U.S. manufacturing and service industries. Defense and aerospace industries are directly affected. China's technological advantage extends to military hardware, cybersecurity, and aerospace innovations. U.S. defense contractors must increase spending on research, rapid prototyping, and advanced systems to remain competitive. Delays in procurement, cost overruns, and geopolitical tensions amplify economic uncertainty. Military contracts and related stock valuations experience volatility. Consumer technology markets experience immediate ripple effects. Smartphones, cloud services, AI applications, and consumer electronics produced by Chinese firms outperform U.S. offerings in price, functionality, and efficiency. American companies lose both domestic and international customers, forcing price reductions, strategic partnerships, or service enhancement programs to maintain competitiveness. Revenue growth slows across multiple sectors. Banking and financial sectors face indirect disruption. Firms heavily invested in technology stocks experience portfolio volatility. Venture capital investment slows for US-based startups as Chinese innovation threatens market dominance. Hedge funds, mutual funds, and pension funds reassess exposure to high-tech sectors, driving short-term instability in equity markets. Risk management strategies are updated to accommodate increased competition and global uncertainty. Employment patterns shift. High-tech roles in AI, software development, and advanced manufacturing face pressure as U.S. companies adjust hiring and project planning. Layoffs or slowdowns in certain sectors occur as firms focus resources on high-priority innovation pipelines. Conversely, domestic labor may experience reskilling initiatives to adapt to emerging technology challenges. Workforce disruption contributes to broader economic uncertainty. Global financial markets react to the redistribution of technological power. European, Asian, and emerging markets realign trade and investment strategies. China's leadership in technology attracts foreign investment, expanding global influence while the U.S. experiences relative decline. Currency volatility, capital flight, and investment reallocation challenge U.S. economic stability and investor confidence. Corporate debt levels become critical. Firms investing heavily in research and expansion to counter China's advantage take on significant debt. Rising interest rates, market volatility, and operational risk increase financial pressure. Companies face potential defaults or restructuring if innovation fails to translate into competitive products or revenue gains. Energy and infrastructure industries face secondary impacts. Chinese technological advancements in renewable energy, battery storage, and grid efficiency outpace U.S. innovations, reducing American exports and competitive edge. Energy companies adapt to remain cost competitive, while investing heavily in domestic R&D, creating capital allocation challenges. Stock valuations reflect long-term uncertainty. Higher education and research institutions experience shifting dynamics. Collaboration with Chinese universities and tech firms declines, while U.S. institutions attempt to accelerate domestic innovation initiatives. Funding is redirected toward national security-related R&D and strategic industries. International student recruitment may be affected as China emerges as a dominant technology hub, drawing talent away from U.S. universities. Venture capital and startup ecosystems face turbulence. Chinese technology startups dominate global innovation pipelines in emerging sectors. U.S. venture capitalists are forced to adjust investment strategies, emphasizing speed, differentiation, and IP protection. Many American startups fail to scale in the shadow of Chinese competition, reducing domestic innovation output and employment opportunities. Consumer markets react to technological superiority. Chinese-made AI platforms, communication devices, and cloud services offer superior functionality at competitive prices. U.S. companies reduce margins to remain viable, impacting profitability. Domestic consumers benefit from lower-cost alternatives but create long-term dependency on foreign technology, influencing strategic and economic independence. Defense spending surges. Government investment in advanced military technologies, cybersecurity, and space programs increases to counterbalance China's advantage. Budget allocations shift from domestic programs to military R&D. Stock markets respond with volatility as defense contractors experience increased demand, but other sectors suffer due to resource reallocation. Global trade negotiations are affected. U.S. leverage in international trade agreements diminishes as China's technological advantage strengthens bargaining positions. Export controls, tariffs, and strategic investments are reassessed to retain competitiveness. Companies face higher compliance costs and potential market access limitations. Corporate strategy pivots toward resilience. Companies diversify supply chains, invest in automation, and implement advanced R&D programs. Capital expenditure increases, operational costs rise, and profit margins are squeezed. Firms unable to adapt face revenue decline, layoffs, and potential bankruptcy. Stock prices adjust to reflect competitive uncertainty. Healthcare and biotechnology sectors are impacted. Chinese breakthroughs in AI-assisted diagnostics, gene editing, and pharmaceutical production challenge U.S. dominance. American biotech firms face competitive pressure, revenue decline, and delayed research commercialization. Intellectual property disputes and licensing negotiations complicate innovation pipelines. Small and medium-sized enterprises face secondary consequences. Many depend on technology infrastructure, cloud services, and software developed in the U.S. firms reliant on outdated or less efficient technology struggle to remain competitive in markets increasingly dominated by superior Chinese solutions. Market consolidation occurs as smaller firms are acquired or fail. Employment effects are uneven. Skilled technology workers are highly sought after, leading to wage inflation in some areas. Conversely, firms with limited resources face layoffs, hiring freezes, and project delays. Workforce retraining and upskilling initiatives are accelerated but insufficient to match the speed of Chinese technological progress. Global economic influence of the United States declines. Emerging markets increasingly adopt Chinese technologies, partnerships, and supply chains. American multinational firms lose market share abroad, reducing U.S. global leverage in technology, trade, and finance. Geopolitical influence diminishes as China's superior technology provides both soft and hard power advantages. Corporate investment slows. Firms reassess mergers, acquisitions, and expansion plans in light of Chinese technological dominance. Venture capital and private equity allocations shift to sectors resilient to competition. Startups dependent on cutting-edge innovation face funding scarcity, reducing overall domestic innovation output. Consumer technology adoption accelerates toward Chinese products. Smartphones, AI platforms, and industrial solutions dominate global markets. U.S. companies respond with price reductions, marketing campaigns, and strategic alliances. Market volatility increases as companies struggle to maintain profitability under competitive pressure. Stock market indices remain volatile. Technology-heavy indices experience prolonged periods of correction as investors weigh U.S. companies' ability to compete globally. Defensive sectors gain relative strength, including consumer staples, utilities, and traditional industrials. Institutional investors adjust portfolios to mitigate exposure to high-risk, technology-reliant equities. Corporate debt pressures mount. Firms investing heavily to compete with China incur higher leverage. Rising interest rates and declining profitability increase default risk. Financial institutions closely monitor exposure, adjusting lending strategies and credit risk assessments. Bond markets reflect the increased uncertainty. Innovation pipelines are stressed. Research and development programs face pressure to accelerate, increasing operational costs. Collaboration with international partners is complicated by geopolitical considerations, IP disputes, and talent migration. U.S. leadership in AI, semiconductors, and aerospace is challenged, reshaping long-term economic and technological trajectories. Global supply chains realign. Countries and corporations favor Chinese technology and production capabilities. U.S.-based suppliers experience revenue loss, reduced market access, and increased competition. Industrial and consumer product sectors adjust sourcing strategies, increasing operational costs and uncertainty. Financial markets experience persistent volatility. Equity indices, commodity markets, and currency valuations fluctuate as investors reassess risk. Investor confidence depends on corporate adaptation, government policy, and global market stabilization. Asset allocation strategies are modified to mitigate exposure to technology disruption and revenue risk. Defense and national security considerations dominate policy. Government funding shifts to R&D, cybersecurity, advanced weaponry, and space exploration to counter China's advantage. Domestic fiscal priorities, including social programs and infrastructure, face funding constraints. Stock markets react to policy shifts with sector-specific volatility. Higher education faces challenges in attracting and retaining talent. Chinese dominance in technology draws global students and researchers toward China, reducing U.S. talent inflow. University revenue from tuition and research collaboration declines. Workforce development initiatives are implemented but insufficient to compensate fully for lost expertise. Corporate mergers, acquisitions, and strategic partnerships slow. companies reassess international collaborations and domestic growth strategies. Venture capital and private equity become cautious in funding technology startups facing unprecedented global competition. Consolidation occurs in sectors unable to match Chinese technological leadership. Employment patterns shift dramatically. Skilled roles in technology, AI, and advanced manufacturing experience wage pressure, while lower tech roles face job insecurity due to company restructuring and automation initiatives. Domestic workforce development programs are accelerated, but long-term gaps remain. Consumer markets reflect increased dependence on foreign technology. Products incorporating Chinese innovation dominate sectors previously led by U.S. companies. Price competition benefits consumers but creates strategic risk and dependency. Corporate profitability and market share decline, reducing stock valuations. Ultimately, China's technological superiority creates cascading consequences across the U.S. economy. Stock markets experience sustained volatility, corporate revenue and profitability are challenged, global competitiveness declines, and geopolitical influence weakens. Recovery requires significant investment, workforce adaptation, and policy coordination to restore U.S. technological leadership. The scenario underscores the fragility of economic dominance in a globally interconnected market. It demonstrates how technological breakthroughs in a competitor nation can disrupt industries, destabilize financial markets, and reshape long-term economic trajectories. The U.S. faces a crossroads: accelerate innovation, invest in human capital, secure supply chains, and redefine global strategy, or risk long-term economic and technological decline in the face of Chinese superiority. The consequences extend far beyond Wall Street, affecting employment, consumer choice, national security, and international influence for decades to come.